Welcome everyone to our podcast where we deep dive into the forces shaping the global economics. I'm your host Tom Chudin, and today we are tackling a topic that's been the heart of a central banking since the 2008 financial crisis. That is the unconventional monetary policy, including tools, effectiveness, and implications. When the interest rate hit rock bottom, central bank turned to unconventional tools like the quantitative easing, negative interest rate, and forward guidance to stimulate economics. But how effective are these tools and what are their long-term consequences? Joining me today are the three distinguished experts. Firstly, we have Dr. Sushana Darje, a former senior economist at the European Central Bank, who was involved in shaping the European Central Bank's response to the European debt crisis. And secondly, we have Dr. Rinzan Singh, a monetary policy expert from the Bank of Japan, which has been a pioneer in unconventional policies for decades. And then we have Dr. Bimal, a Federal Reserve analyst who has studied the US quantitative easing program post-2008. Let's get started. So, Dr. Sushana Darji, can you please kick us off by explaining what you mean by the unconventional monetary policy and the main tools the central banks use?
Thank you, Tom Chudin. Unconventional monetary policy, or UMP, refers to measures central bank uses when traditional tools like adjusting short-term interest rates are no longer effective, typically when rates approach zero, known as the effective lower bound. The main tools include 1. Quantitative easing. Central banks purchase large quantity of assets like government bonds or mortgage-backed securities to inject money into the economy and lower long-term interest rates. 2. Forward guidance. Communicating future policy intentions to shape market expectations about interest rates. 3. Negative interest rate policy, changing banks for holding reserves to encouraging lending. Now 4. Credit easing, targeted purchases of specific assets to improve liquidity to stressed markets. The ECB, for instance, used quantitative easing extensively during the 2010s. Between 2015 and 2018. Our asset purchase program bought over Euro 2.6 trillion in bonds, reducing 10-year government bond years in countries like Spain and Italy by about 1 to 2 percentage points, which helped stabilize markets during the debt crisis.
That's a great overview, Sushana. Dr. Rinzan Singh, Japan has been using these tools for longer than most. Can you share how the Bank of Japan has applied the unconventional monetary policy?
Thank you for the question, Tom. Japan's experience with unconventional monetary policy began in early 2000s after our economic bubble burst. The Bank of Japan introduced quantitative easing in 2001, purchasing government bonds to combat deflation. By 2013, under the Abenomics, we scaled up with the quantitative and qualitative monetary easing program, buying 20 trillion yen in assets annually at its peak. This lowered 10-year Japanese government bond yields from 0.8% to near 0% by 2016. We also adopted negative interest rate policy in 2016, setting a negative 0.1% rate on some bank reserves and introduced yield curve control to keep long-term rates stable. These measures aim to break persistent deflation, though inflation has remained below our 2% target, averaging 0.5% from 2013 to 2020.
Fascinating. Dr. Pemudaji, what about the US? How has the Federal Reserve used these tools?
Thank you for the question. Let me answer. The Federal Reserve turned to unconventional monetary policy during the 2008 financial crisis when the federal funds rate hit near zero. We launched 3 rounds of quantitative easing between 2008 and 2014, purchasing over $4 trillion in treasury bonds and mortgage-backed securities. This expanded the Fed's balance sheet from $1 trillion to $4.5 trillion by 2014. Studies like one by Krishnamurthy and Vissing Jorgensen in 2011 estimate quantitative easing lowered 10-year treasury yields by about 0.2 to 0.3 percentage points. Forward guidance was also key. In 2011, the Fed signaled low rates through mid-2013, reducing 2-year treasury yields by 0.1%, and these tools helped stabilize markets and supported recovery, with US GDP growth averaging 2.1% annually from 2010 to 2019.
Thank you for laying out the tools and examples. Let's dive into effectiveness. This question is again for you, Dr. Pemudaji. How well did the Fed's quantitative easing program work in the United States?
Thank you for the question again. The Fed's quantitative easing programs were largely effective in stabilizing financial markets and boosting recovery. For example, the quantitative easing phase 1 in 2008 reduced mortgage spreads by about 1%, making borrowing cheaper and supporting the housing market. Unemployment fell from 10% in 2009 to 5% by 2015, partly due to increased lending and consumer spending spurred by quantitative easing. However, the impact on inflation was modest. Core inflation remained below the Fed's 2% target, averaging 1.8% from 2010 to 2019. Critics argue quantitative easing increased wealth inequality by boosting asset prices, benefiting wealthier households. A 2018 study by Gardner notes that quantitative easing effects on real economic activity were positive but smaller than hoped, as much of the stimulus stayed in financial markets.
Interesting trade-offs. Dr. Rinzin, Japan's experience seems more mixed. So what's your take on effectiveness?
Once again, thank you for your question. Japan's unconventional monetary policy has had mixed results. Quantitative easing and negative interest rate policy lowered borrowing costs and stabilized markets, but they haven't fully defeated deflation. Despite massive asset purchases, inflation averaged only 0.5% from 2013 to 2020, far from our 2% target. Real GDP growth was also sluggish, averaging 1% annually. One issue is that banks facing negative rates didn't lend as much as expected. They lent onto reserves instead. However, yield curve control has been effective in keeping Japan's borrowing cost predictable, supporting corporate investment. A 2024 Bank of Japan study noted that unconventional monetary policy prevented deeper deflation but highlighted side effects like reduced bank profitability.
Thank you for your response, Dr. Rinzan. The European Central Bank program also faced challenges. So, Dr. Sushana, how effective were they in the Eurozone?
Thank you for the question, Ms. Cha. The European Central Bank's unconventional monetary policy, particularly the outright monetary transactions program announced in 2012, was a game changer. Without even being activated, OMT's promise to buy unlimited government bonds lowered Spanish and Italian 10-year bond yields by 2 to 3 percentage points, averting a Eurozone collapse. OE from 2015 also boosted GDP growth by an estimated 1.3% cumulatively by 2018. According to ECB research, however, a 2019 research in the review of financial studies found that weakly capitalized banks engaged in zombie lending, post-OMT lending to low productivity firms, which slowed recovery. This shows UMP can stabilize markets but risks misallocating credit if not paired with structural reforms.
Those are critical points about the effectiveness and unintended consequences. Let's talk about implications. Dr. Sushana, what are the long-term risks of unconventional monetary policy in the Eurozone?
Thank you for the question again. Unconventional monetary policy can distort markets if used too long. For example, quantitative easing inflated asset prices with Eurozone stock indices like the Euro Stoxx 50 rising 20% from 2015 to 2018, benefiting investors but not necessarily the broader economy. Prolonged low rates also hurt savers and pension funds, which struggled with low yields. Another risk is fiscal complacency. Governments may delay reform, assuming central banks will keep rates low. The European Central Bank's balance sheet grew to €4.7 trillion by 2020, raising concerns about how to unwind it without disrupting markets. Exit strategies are tricky. Tightening too fast could spike yields and trigger recessions.
Thank you, Dr. Sushana. Japan's been grappling with this policy for decades. So, what lessons can others learn from this, Dr. Rinzan?
Thank you for your question. Japan's experience shows that unconventional monetary policy is not a silver bullet. Long-term quantitative easing has led to a bloated Bank of Japan balance sheet, 700 trillion yuan by 2023, nearly 120% of GDP. This creates dependency where markets expect endless support, making exit difficult. Negative rates also squeezed bank margins. Japanese banks' net interest margin fell to 0.8% by 2019. Another lesson is that unconventional monetary policy works best with fiscal and structural policies. Without reforms to boost productivity, Japan's growth remained low, averaging 1% annually. Central banks must communicate exit plans clearly to avoid market panic, as we saw when yields spiked in 2013 after hints of Fed tapering.
That was very fascinating to know. Dr. Pematoji, what about the implication for the US economy and beyond?
Thank you for the question. In the US, quantitative easing helped during crisis but fueled asset bubbles. The S&P 500 rose 50% from 2009 to 2014, partly due to low rates, widening wealth gaps, and internationally, US quantitative easing depreciated the dollar, with a 2008 to 2009 study showing a 10% drop against major currencies after quantitative easing announcements, boosting US exports but causing capital flow volatility in emerging markets. Another concern is moral hazard. Banks may take bigger risks, expecting central bank bailouts. The Fed's balance sheet is still at $7 trillion in 2023, poses challenges for normalization. A 2019 BIS report warns that prolonged UMP can disincentivize private sector deleveraging, storing up future risks.
Let's ground this in real-life examples. Dr. Pemadaji, can you share a specific case from the United States?
During the COVID-19 pandemic, the Fed relaunched quantitative easing in March 2020, buying $3 trillion in assets by mid-2021. This lowered 10-year Treasury yields from 1.1% to 0.7% and supported markets, with the S&P 500 recovering 60% from its March 2020 low by year-end. Unemployment dropped from 14.7% in April 2020 to 6.7% by December. However, inflation surged to 7% by late 2021, partly due to excess liquidity, prompting the Fed to taper quantitative easing and raise rates in 2022. This shows UMP's power, but also its inflationary risks.
Thank you for your response. Dr. Sushama, what about the European Central Bank's response to the COVID-19?
Thank you for the question. The European Central Bank launched the Pandemic Emergency Purchase Program in March 2020, buying €1.85 trillion in bonds by 2022. This stabilized market, reducing Italian 10-year bond yields from 2.4% to 1.2% by mid-2020. Eurozone GDP contracted 6.4% in 2020 but rebounded 5.3% in 2021, partly due to PEPP. However, inflation hit 8.4% in 2022, forcing the ECB to end quantitative easing and raise rates. The challenge was balancing stimulus with inflation control, especially with supply shocks from the pandemic.
Thank you so much, Dr. Sushama. Dr. Renzin, any recent insights from Japan?
Once again, thank you for your question. In 2020, the Bank of Japan expanded quantitative easing, increasing bond purchases to 120 trillion yen annually to support markets during COVID-19. This kept 10-year Japanese government bond yields near 0%, stabilizing borrowing cost. Japan's GDP contracted 4.5% in 2020 but grew 1.6% in 2021. However, inflation remained low at 0.2%, showing unconventional monetary policies' limited impact on price levels in Japan's deflationary environment. The Bank of Japan's challenge is unwinding its massive balance sheet without disrupting markets.
Thank you all for an insightful discussion. Let's wrap up with a key takeaways. Unconventional monetary policies like the quantitative easing, forward guidance, and negative interest rates have been critical in stabilizing economics during crisis, from the 2008 financial meltdown to COVID-19 pandemic. In the US, the quantitative easing lowered the yields and unemployment but raised inflation and inequality. In Eurozone, the OMT and the PEP averted collapses but led to issues like zombie landing. In Japan, the unconventional monetary policy prevented deeper deflation but struggled to hit inflation targets. Across all cases, side effects like asset bubbles, bank profitability issues, and exit challenges highlight the need for a careful implementation and complementary fiscal policies. What's clear is that the unconventional monetary policy remains a vital tool, but it's not without risks. A central bank must balance the short-term stimulus with a long-term stability, and that's a debate we will keep watching. Thank you, Dr. Rinzen, Dr. Pema, and Dr. Sushana for sharing your expertise.
And to our listener, join us next time for a more deeper dive into this world of economics. Until then, stay curious. Thank you.